Debt Mutual Funds, Understanding the Experience, an investor education initiative by Aditya Birla Sunlife Mutual Fund. We all have a favorite restaurant where you usually hang out with friends. Let's say you've been enjoying Punjabi cuisine in this restaurant for years. On one of the occasions, you tried Italian food. But unfortunately, it didn't suit your taste at first. Your friends, who had experienced it earlier, seemed to have liked it. Does it mean that there is something wrong with the Italian food or your choice of cuisine? Not really. It could simply mean that you are not well aware of the Italian cuisine and need time to develop a taste for it. But your last unpleasant experience with Italian cuisine makes you think otherwise. This tendency to make decisions based on the most recent events is known as recency bias, and it is very common. This phenomenon holds true across every walk of life, even investing. For years, millions of investors have preferred debt mutual funds for all their saving needs, as debt funds aim to provide stability to your portfolio with relative capital protection orientation and stable returns. Diversification through investments in government securities, corporate bonds, treasury bills and other debt instruments. Better tax efficiency through indexation benefit on long-term investments. Despite these benefits and track record, the recent credit events in few companies have developed recency bias amongst some investors and have raised questions about efficiency of debt mutual funds. But remember, in order to make right decisions, be it in food or investments, you should come out of recency bias. Let's not get influenced by the recent events and understand more about debt mutual funds. Your money in debt funds is invested primarily across various debt instruments for predefined maturity period and interest rate, and the fixed interest offered by the issuer, known as coupon, is the accrual income of debt fund. During the period when the fund is generating interest income, factors such as interest rate fluctuations, credit migration, and default risk may influence overall performance of the fund. But to tackle these uncertainties, fund manager diversifies the overall portfolio across debt instruments, across maturity, sectors, companies, and credit profiles. So, if one company defaults, coupon offered by rest of the issuer companies can compensate for the same, thereby effectively mitigating the risk. Let's understand this with an example. The fund has a diversified portfolio of 50 holdings that earn 8% interest every year. If today 1% of the portfolio defaults, which is a rare case, remaining 99% of the portfolio continues to give interest of 8%, still fetching the effective returns of 7.69%. Now, when we have seen that how various factors affect debt mutual funds, let's see how debt mutual funds industry has performed over the years. Currently, total assets under management of Indian debt mutual funds industry stands at rupees 13.4 lakh crore with a huge investor base, of which 93.7% are made in high quality papers, 6.11% in moderate quality papers, and mere 0.19% are in low grade quality papers. Thus, likelihood of performance of the debt fund getting affected by default risk is insignificant. While it is true that returns in short term might get affected by market volatility, long-term trends are likely to be linear. Thus, avoid paying heed to the recent events and ignore the noise before making any investment decisions. because they are minuscule part of the overall investment portfolio and are unlikely to happen frequently, while fund managers aim to minimize the risk through adequate diversification. So, the bottom line is, given time and patience, debt mutual funds can help you generate relatively stable returns over the years. An investor education initiative by Aditya Birla Sunlife Mutual Fund. Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.